Thank you for joining today. And my name is Masato Sakai from Rimto Accounting. And I am a Japanese CPA. And I work with both Japanese and foreign companies on tax, finance, and accounting matters. So today I want to give you a simple but practical overview of what foreign startups need to know when doing business in Japan. So we'll look at 4 key areas, how Japan's tax system work at a very high level, what type of company you might set up in Japan, Japan's 10% consumption tax and the new invoice rules, and the true cost of hiring employees in Japan. Please think of this as a roadmap. I am not going to deep dive into details, but my intention is to give you a guidance to avoid surprises and prepare for success. Okay, first, let's look at Japan's tax landscape. There are 3 main taxes every startup should know: corporate tax, consumption tax, and individual income tax. And for corporate tax, companies pay around 30% on profits. This isn't just one tax. This is a combination of national corporate tax plus local taxes like inhabitant tax paid to your city or prefectures. So when we say 30%, that's the combined effect of national and local layers. For example, your company earns 10 million in profits, except around 3 million in total, spread across these different level governments. And next one is consumption tax, Japan's version equivalent of VAT. 10% of most sales of goods and services. And individual income tax. Individuals pay progressive rates reaching up to around 50% for very high incomes. Again, because both national and local taxes are combined. And on top of all this, both employers and employees contribute to Social Security, health insurance, and pensions. So for employers, this adds about 15% on top of salaries. So in short, Japan is not low tax, but it is stable and predictable. So you just need to understand that national and local governments share the tax pie. Okay, next, what type of entity should you set up in Japan? Oh, basically, foreign companies usually choose between 株式会社 KK, 合同会社 GK, and branch office. The KK is the classic corporation. It has the highest credibility with banks, partners, and clients. It would be a good choice if you want to raise funds or look serious in Japan. And 合同会社 GK is similar to an LLC, which is cheaper and simpler to run. And these days, it's increasingly respected. And even big names like Apple Japan use this form. And last one is branch office, which is an extension of your foreign company. It's quicker to set up, but it's often seen as less credible. So of these 3, most startups choose KK or GK. Tax treatment is the same, but KK gives you some prestige, while GK gives you flexibility and lower costs. Now, let's return to consumption tax, the 10% sales tax. So this is an indirect tax, and businesses add 10% to their sales and pass it to the government. So for instance, you sell something for 1,000 yen, you charge 1,100 yen. So traditionally, new companies enjoy the exemption. If your sales were under about 10 million in the first 2 years, you didn't have to register or pay consumption tax. Some startups even collected the 10% and legally kept it, which boosted the cash flow in early stage. But since October 2023, Japan introduced the qualified invoice system, and only registered companies can issue invoices that let their clients reclaim the 10% tax. So if you stay unregistered, your business clients can't get their tax credit, which effectively makes your service 10% more expensive. So while the exemption technically still exists, for most B2B startups, it's not practical. The safe route is usually to register early, issue proper invoices, and keep your clients happy. Okay. Finally, let's talk a little bit about hiring. When you bring on employees in Japan, the cost is more than just the salary you agree on. You withhold income tax from their pay and send it to the tax office. And so you also enroll them in Social Security, covering health, pension, and unemployment. For employers, this adds about 15% extra cost on top of the salary. For instance, if you hire someone for 5 million yen per year, the true cost to your company is closer to 5.75 million. This extra 15% cost surprises many foreign startups, so it's important to budget correctly when planning to build a team in Japan. Okay, to sum up, here are the 4 essentials to remember. Number 1, plan for around 30% corporate tax. Number 2, choose KK, GK for your company setup. Both are solid choices. Number 3, register for consumption tax if you work B2B. The old exemption is less useful after the new invoice rules. And number 4, budget 15% extra for hiring costs on top of salaries. So Japan's system may look heavy at first, but it's clear and rule-based and predictable. The structure is well structured, which helps startup build credibility and long-term trust. So carefully planning and consulting with local tax experts and social security experts are essential to protect your business from unnecessary tax exposure and non-compliances with local regulations. So thank you all for your time and attention today. And I hope you found this presentation both informative and valuable to some extent. And I look forward to chatting with you all. Thank you very much.